What if saving money is actually keeping you from getting richer? That sounds strange. We're always told to save. Save for emergencies. Save for a house. Save for retirement. And yes, saving matters. But there's a point where saving stops being the finish line and needs to become the starting line. Because if you keep $10,000 sitting in cash for years, you have $10,000. But if you learn how to put that money to work, it can potentially become much more over time. So the real question isn't, how much money can I save? It's, when should my savings start working for me? In this video, I'll show you a simple step-by-step path from saving your first dollar to building an investment system that can grow with you. And we'll use real-world American examples, because investing isn't just something wealthy people do. It's one of the ways ordinary people can build wealth over decades. Let's make this simple. Saving protects money. Investing puts money to work. Think about your emergency fund. You don't want your emergency money sitting in something that can suddenly drop 20% right when your car breaks down or you lose your job. That money has a job. It needs to be available. Investing has a different job. Its job is long-term growth. And that difference is extremely important. Imagine you have $15,000. You could say, I have $15,000 saved. I'm doing great. And you are. But now ask yourself, how much of that $15,000 actually needs to stay in cash? Maybe some of it is your emergency fund. Maybe some is for a near-term purchase. But if part of that money won't be needed for many years, why should all of it sit on the sidelines? That's where the transition from saving to investing begins. Before you start chasing investment returns, build a floor underneath yourself. For many Americans, that starts with an emergency fund. You don't need to become a millionaire before investing. But you also don't want one unexpected bill to force you to sell investments at the worst possible time. Start with a basic target. Maybe it's $1,000. Then work toward 1 month of essential expenses. Eventually, depending on your situation, you may want several months of essential expenses saved. The exact number is personal. Your rent is different. Your income is different. Your job security is different. Your family situation is different. But the idea is simple. Build enough cash so life doesn't force you to interrupt your long-term investments. Because here's the uncomfortable question. What good is a great investment strategy if one $3,000 emergency makes you sell everything? Now we have another problem. High-interest debt. Let's say you have a credit card balance charging you around 25% interest. And you're thinking, I'm going to invest because the stock market can make around 10% a year over the long run. See the problem? You are trying to earn a return on one side, while losing money at a much higher rate on the other. Paying down expensive debt can be one of the most powerful financial moves you make, especially credit card debt. Think about it. If you eliminate a 25% interest cost, that's money you are no longer losing to the lender. You don't need the stock market to cooperate. You don't need a perfect investment. You simply stop the leak. So before aggressively investing, ask, is my money working for me, or am I paying someone else to use it? Now we get to one of the easiest wins in investing, your employer retirement plan. For example, a 401k. If your employer offers a matching contribution, pay close attention. Let's say you contribute $300 from your paycheck, and your employer adds another $150 based on the plan's match. You didn't have to find another job. You didn't have to pick a hot stock. You simply participated in the benefit your employer already offered. Of course, every employer plan is different, so learn the actual matching rules. But if you're leaving a meaningful employer match on the table, that's worth fixing. And this is where saving starts turning into investing automatically. Money comes out of your paycheck. It gets invested. You don't have to make the decision every Friday. That's powerful, because successful investing is often less about predicting the future and more about building a system you can stick with. Once your financial foundation is stable, the next question is, where should you invest? This is where people make investing sound much more complicated than it needs to be. You have 401ks, IRAs, Roth IRAs, traditional IRAs, taxable brokerage accounts, and each one has different rules. For many workers, a 401k can be a strong starting point, especially when an employer match is available. Then there are IRAs. A Roth IRA, for example, can be attractive for people who qualify because contributions are made with after-tax dollars, while qualified withdrawals in retirement can generally be tax-free. But don't just open an account because someone on social media told you it's the best. Your income, tax situation, age, goals, and employer benefits matter. The account is the container. The investment is what goes inside it. And that brings us to the next step. This might be the hardest part. Because investing is supposed to feel exciting, right? Someone posts, this stock is about to explode. Another person says, this is the next big AI company. Someone else is showing screenshots of a huge trading profit. And suddenly your boring index fund feels boring. But here's the thing. Boring can be incredibly powerful. A diversified index fund can give you exposure to many companies instead of forcing you to bet everything on one. You don't have to predict which company will dominate the next 20 years. You can own a broad slice of the market and then keep adding, month after month, year after year. That's not exciting. But wealth doesn't have to be exciting. Here's where everything starts coming together. Imagine an American worker earns $5,000 a month after taxes. Instead of waiting until the end of the month to see what's left, they automatically send $500 toward long-term investing. That's 10%. The money leaves before lifestyle inflation gets a chance to grab it. Then something interesting happens. After a few months, the person stops thinking about that $500 as spending money. It becomes part of the system. And when their income increases, maybe they increase the investment. A $500 monthly investment becomes $600, then $750, then $1,000. That's how small decisions become big financial changes. Not overnight. Over time. Let's say you invest $500 every month. That's $6,000 a year. If your investments earned an average annual return of 8% over a long period, the numbers can become surprisingly large. After 10 years, you would have contributed $60,000. But the account could be worth roughly $91,000. After 20 years, you would have contributed $120,000. The account could grow to roughly $295,000. And after 30 years, you contributed $180,000. At an 8% average return, the account could reach roughly $745,000. Those are hypothetical illustrations, not guarantees. Markets don't deliver a smooth 8% every year. Some years are great. Some years are terrible. But that's the point. Compounding needs time. The earlier dollars get invested, the longer they have to potentially grow. So ask yourself, would you rather invest more money later or give your money more time now? Here's a trap that quietly destroys investing progress. You get a raise. Then your apartment gets nicer. Your car gets more expensive. You eat out more. Subscriptions multiply. And somehow, you still feel broke. Your income increased, but your wealth didn't. So try something different. Every time your income rises, give part of that raise to your future self. Maybe you get a $5,000 annual raise. You don't have to invest all of it. Maybe you increase your retirement contribution. Maybe you add $200 a month to your investments. And you can still enjoy some of the raise. That's the balance. You don't need to live like you're broke forever. You just don't want every income increase to disappear into a more expensive lifestyle. This one is huge. If you're investing for 20 or 30 years, why are you checking your account every morning? The market goes up. The market goes down. You will see red. You will see green. There will be headlines saying the economy is collapsing. Then 6 months later, everyone will be celebrating the next market rally. If your entire plan depends on predicting those headlines correctly, that's not a plan. That's a guess. Instead, know your time horizon. Know why you're investing. Know how much risk you can actually handle. Then let the system do its job. Your biggest advantage isn't predicting tomorrow. It's staying invested long enough to let time work. So let's put everything together. Step 1. Save enough cash to protect yourself. Step 2. Attack expensive debt. Step 3. Take advantage of employer retirement benefits and matching contributions. Step 4. Use the right investment accounts for your situation. Step 5. Choose diversified investments you understand. Step 6. Automate your contributions. Step 7. Increase your investments as your income grows. And Step 8. Give the strategy enough time to work. That's the path. Saving is the foundation. Investing is the engine. And time is the fuel. You don't need to start with $100,000. You don't need to understand every financial term. You don't need to find the next Amazon. You need a system. Because here's the question I want you to think about. If you keep doing exactly what you're doing today, where will your money be 10 years from now? And if you change just one thing, what could be different? Maybe you automate another $100 a month. Maybe you finally build that emergency fund. Maybe you stop carrying expensive credit card debt. Maybe you start contributing enough to your 401k to capture the full employer match. Small moves don't look impressive on day one, but wealth is usually built by doing simple things for an unusually long time. Your goal isn't to become rich next month. Your goal is to become financially stronger every year. And that's how saving turns into investing. Not with one giant move, but one smart step at a time. If this video helped you see your money differently, hit the like button. And if you want more simple, practical money videos for the American economy in 2026, subscribe to the channel. Because the goal isn't just to make more money. It's to make your money work harder for you. I'll see you in the next video.